If Congress doesn't act before the end of the year, tax cuts that have been in place for nearly a decade will expire. ABC 15 investigator Joe Ducey asked the CPA how this will affect you.
There's no magic pills to completely avoid paying any taxes.
CPA Julie Kern says if what's known as the Bush tax cuts are allowed to expire, the federal income tax bill for an average two-income family will go up about $2,500 a year.
The higher income households are more likely to experience a loss of the tax cuts as opposed to the lower income households.
Now here's a breakdown of specific things that will change. Tax brackets will increase anywhere from 3 to 5%, with the lowest bracket at 15% of income and the highest at 39.6%. Long-term capital gains taxes will increase from 15% to 20%. The amount exempt from estate tax when you die will fall from $3.5 million to just $1 million. The child tax credit will drop from $1,000 to $500. And the so-called marriage penalty and the standard deduction will return. The expiring taxes won't impact your 2010 filing, but you'll notice it first thing next year.
People filing returns in April of 2011, you won't see an increase, other than you'll see smaller paychecks due to higher withholding rates that begin in January of 2011.
Kern says it's important to meet with an accountant and come up with a tax planning strategy to minimize the impact. We put all of this information on ABC15.com. Click on the Money tab and Consumer Alerts. I'm investigator Joe Ducey, ABC 15 News.